Most investors look at returns. Smart investors look at risk-adjusted returns. Because in Bitcoin, anyone can make money in a bull market. The question is, how much risk did you take to get there? The Acumen BTC Risk Metrics dashboard give you something most crypto platforms don't: a quantitative framework, the same tools used by hedge funds and institutional investors, applied directly to Bitcoin. Let's break down each metric, one by one. To access Bitcoin's risk metrics, just head on to the Advanced Analytics dashboard and click on Risk Metrics on the top. Let's begin with the Sharpe ratio. The Sharpe ratio measures return per unit of total risk. Simple formula: take your return, subtract the risk-free rate, divide by volatility. A Sharpe above 1.0 is considered good, above 2.0, excellent. Right now, Bitcoin's 4-year Sharpe is 0.69, labeled marginal. That means returns are barely compensating for the volatility you're taking on. Not a red flag, but a signal that we're not in peak efficiency territory. The Sortino ratio is the smarter version of Sharpe. Here's the difference. Sharpe penalizes all volatility, up and down. Sortino only penalizes downside volatility, the bad kind. For an asset like Bitcoin, that distinction matters. Right now, the Sortino is 1.1, rated good. Returns are exceeding the downside risk taken. That's a healthier signal than the Sharpe alone suggests. Max drawdown is exactly what it sounds like, the largest peak-to-trough decline in the selected period. In the current 4-year window, Bitcoin's max drawdown was minus 53.1% from October 2025 to June 2026. This is critical context. If you invested at the peak and held through that drop, you were down more than half your position at the worst point. Understanding max drawdown helps you size your position correctly, because the question isn't just, will Bitcoin go up? It's, can I stomach a 50% drop without selling? Now, let's break down the Kalmar ratio. The Kalmar ratio connects return and drawdown directly. Formula: annualized return divided by max drawdown. At 0.59, Bitcoin is generating about 59 cents of annualized return for every dollar of maximum drawdown risk. The higher this number, the more efficient the risk-reward profile. It's a quick sanity check. Are the returns worth the pain? And 3 more cards to complete the full picture: annualized return, annualized volatility, and buy and hold return. The annualized return shows the compound annual growth rate, or CAGR, over the selected time period. In this example, Bitcoin generated an average annual return of 31.4%. Think of this as our starting point. The next question is, how much risk did we have to accept to earn that return? Moving on, we have the annualized volatility. In this example, the value came at 50.7%, calculated as daily standard deviation times the square root of 365. This is high, but for Bitcoin, it's historically normal. The volatility is the price of admission for those returns. Higher volatility means larger price swings, both upward and downward. Bitcoin is naturally a highly volatile asset, so understanding this metric is essential before evaluating any investment performance. And the bottom line? Buy and hold return, 198% total over 4 years. If you bought and held for 4 years, you nearly tripled your money. Buy and hold return shows the total return an investor would have achieved by simply purchasing Bitcoin at the beginning of the selected period and holding it until the end. No trading, no market timing, just long-term ownership. Now let's put it in context. The S&P 500 over the same 4-year period, annual return plus 13.8% versus Bitcoin's plus 31.4%. Max drawdown minus 25.4% versus Bitcoin's minus 53.1%. total return, plus 68% versus Bitcoin's plus 198%. The trade-off is clear. Bitcoin delivers nearly 3 times the return of the S&P 500, but with double the drawdown. This isn't a reason to avoid Bitcoin. It's a reason to size your position correctly. Risk metrics don't tell you what to buy. They tell you how to hold what you already own. Use this dashboard to calibrate your exposure, not to time the market, but to understand the math behind the asset. That's the edge, and now you have it.